All right, y'all. We are live on this beautiful Wednesday afternoon. God bless everybody in the name of Jesus, Yeshua the Messiah. I do hope everybody is super blessed. Guys, we are doing a $3,000 giveaway today no matter what. If you want a chance to win $3,000, we're going to have 5 winners, 6 winners, each getting $500. All you have to do is sign up to KCEX using my link, and you are eligible to win. KCEX, the exchange with the lowest fees in the game, 0% limit order, 0.01% market order. Make sure to check it out. Guys, today is a very important day. As we know, it is the day that the Federal Reserve is going to announce the new interest rates. And of course, baked into the cake at 97.8%, expecting a 25 basis point rate cut. And this is actually going to be a very important FOMC. And I think today what's going to be very important is Jerome Powell's stance after the rate cut is announced. Is he going to be looking hawkish or dovish? We got to give a major shout out to everybody in the chat. Major shout out to Make Me a Millie. We are getting a dump today. Shout out to Levy Schmass. He says a whole bunch of stuff here. God bless you. Shout out to Fred Sloan. Shout out to Mickey J643. Shout out to Red Elephant. Shout out to Blair Force One. Shout out to Bob Riley. Shout out to Preparing for War. Shout out to Felix H. Shout out to Hassan from Pakistan. Shout out to Florida J69. Major shout out to Barry the Rave. What is going on? Shout out to Crypto J253. Christ is King. Amen. And we got to give a major shout to J Boy Bullish. So guys, today we are seeing, as we are getting ready for the FOMC, obviously we are seeing a big dip in the crypto markets. We are seeing Bitcoin down quite a bit. The total market cap is actually falling over 2% today. Pretty intense. And here's the thing. We are getting ready for a 25 basis point rate cut today. And the markets are clearly bracing for the tone and the commentary from our man himself, Jerome Powell, Chair Powell himself. Interestingly enough, guys, we are seeing money rotate into stable coins as we are getting ready for this rate cut decision. This is very interesting. Why? Well, because you would think that everybody would be super bullish, right? Rate cut, 25% basis point rate cut. You know, the Fed is going to be easing its balance sheet. We would expect money to flow into risk assets. This could be very bullish for risk assets, stocks, Bitcoin, altcoins, other coins. But we're seeing a little bit of caution on the side of investors, especially in the crypto space. People are getting into safe territory. All right, people are putting their money, they're taking it out of Bitcoin, they're taking it out of Ethereum, they're taking it out of alts, they're putting it into stable coins like USDT and USDC. Why is this happening? Well, we can only assume here. Obviously, we're not able to read the minds of these crypto investors, but we can only assume that people are awaiting for Jerome Powell's commentary to see what the Fed wants to do leading into 2026 before they make a decision as to where they want to put their hard-earned cash. All right, very interesting stuff as we are waiting for basically this big rate cut decision. I think the key right here is going to be Jerome Powell's tone during the press conference. If he is dovish, this could actually be something quite bullish for Bitcoin and other cryptocurrencies. Why do I say that? Well, let's quickly review what has happened with Bitcoin for the past few days here. We have come up to the top of the range, as can be seen right here, and we basically got a fake out of the top, right? Which is why I took a short trade from the high, from the setup given in the Casper Crew VIP Discord in advance to let everybody know when I took the trade. Okay. We have gotten a move all the way down during that flash crash to around $102,000 on most exchanges. And now yesterday, we're back in this zone around the $115,000 level. Now, we were saying this is such a key level because it's the top of the local range. It is local resistance. And as you can see, we have gotten a bit of a pullback from this local resistance. Okay? Now, this was a great place to take profit, one, on the long trade from the Casper Crew VIP Discord, given in advance, all right? And also is a great place to open up a hedge short, along with your take profit one, all right? Personally, I did take a hedge from that area, as can be seen right here. I have hit a little bit of take profit on that hedge short. And so this is where we are right now, guys. As we await for Jerome Powell's decision, we have to understand that this wick to the downside, this big wick, we're going to start on our daily time frame here. The big wick to the downside could potentially be extremely bullish if we are given a bullish catalyst such as Jerome Powell coming out very dovish. Why do I say that? Well, because we have ourselves right here a very clearly defined sideways range. High of the range at about 125, low of the range at about 105. As we came and we took these lows here, we printed very bullish divergences on market cipher B. You can see that as the price is getting lower, the momentum waves are giving us the coveted uneven butt cheek pattern. Big and juicy on the left, very skinny on the right. We have this on the 1 day time frame. We have this on the 2 day time frame. Bullish divergence on the 2 day time frame. We have bullish divergence on the 3 day time frame, guys. These are high time frames that now have confirmed bullish divergences. And so given the context of Bitcoin having come down, taken the liquidity from these lows at the low of the range, getting about confirming bullish divergences on these high time frames, given that context, if our man JP comes out dovish, saying, you know what, man, we're going to keep cutting rates. We're going to cut them fast and hard, baby. We might even start turning on the dang printing press. He might even say, I mean, imagine if Jerome Powell says, printing press go burr. Imagine if he says those exact words. This could be a catalyst to continue this move to the upside, back up towards the top of our range. Okay? Now we're going to go down to the 4-hour time frame and take a look at how things are looking here. Man. So here's the deal, guys. As we all know, this was a very key resistance as we came up to 115 towards 117. I thought we were going to push up a little bit higher toward 117. Right now you can see we're currently finding a little bit of support on the point of control of the range, right around 111,000, very key level. If this level is lost, then the most probable level is going to be 109.6. 109.6 is the value area low of the range. Also, we can see it's the Fibonacci golden pocket and the 786. So key support to the downside, guys, is going to be right around this green box. I'd say roughly we're talking the 109 to $110,000 zone here. This must hold if we want more upside. Why? Well, because we had ourselves a nice bottom, we had a higher high, we had a higher low, we had a higher high. We're currently rejecting from the top of the range, and so we would expect the bottom of this range to hold for another higher high. This is also going to allow us to trade on this trend line right here, respecting this parallel channel. If this doesn't hold, that does open up the doorway, guys, for a push down to around $102,000, where we have our previous low. So I think today, Jerome Powell, in about, 15 minutes or so, he's going to come out the closet swinging, flapping the old gummaroonies, telling us not only what the interest rates are going to be, but his outlook of the economic situation for the foreseeable future. And again, if he comes out dovish, I believe we are being set up for relief on crypto and other risk assets, but specifically, I'm focused here on the Bitcoin. Okay, I am focused here on the Bitcoin. Weekly time frame, room for upside. 3-day time frame, bullish divergence. 2-day time frame, bullish divergence. Daily time frame, bullish divergence. As long as we can hold this green box here, guys, I'm going to maintain that upside is possible. If Jerome Powell comes out dovish, I will expect a hold from this box, even if we get a flash crash into it. All right. And as for key resistances to our upside, guys, the one thing that we still need to be aware of is going to simply be our Fibonacci golden pocket at around $117,000, confluence with, I'd say, our value area high at around 119.5. This box to the upside is going to be very important resistance. So for us day traders, the key levels that we are looking for to our downside is going to be, I'd say, 109 to around 110. Key resistance to our upside going to be around 117 to 119.5. These are going to be key areas to look for trades. If we breach either of these areas, it opens the door for much more downside or much more upside. All right. These are going to be our main areas of interest for the Bitcoin price. Moving on to Ethereum. Let me go ahead and remove all this TA here. We're going to start on our high time frame with Ethereum. We're going to take a look at our weekly time frame. We are going to recognize the fact that ETH has gotten a major bullish backtest of the point of control of this entire range here, around $3,300. We also have to acknowledge the fact that we've printed a very nice oversold bottom here back in April 2025, and now the weekly momentum looks like she wants to turn to the upside. I'd say that if Bitcoin is going to bounce, we are also going to see ETH bounce. We go to the daily time frame, and what do we see? Well, we see bullish divergences, just like we saw for Bitcoin. We are seeing, as the price is making lower lows here into key support, the momentum waves are making higher lows. Okay, what we did not see for ETH at this high here is bearish money flow. We did see some bearish divergence, but we didn't see bearish money flow. Also for ETH, we are seeing that we have the potential for a major squeeze. We are forming lower highs, which means stop losses, which means liquidity is above, which means if we breach this key trend line, it's opening the door for a big breakout of, in my opinion, the major resistance level that we've had going all the way back to November 2021. If we can breach this, we zoom out here and recognize the fact that this does in fact look like a big old bull flag, right? We have our big flagpole potentially from down here in June. All right. And if we take that as the measured move, we could see a move up to around a $7,000 ETH. $7,000 ETH. Now, to me, $7,000 ETH is a beautiful target, a very technical target. Why? Well, our trend-based Fibonacci extension from the bear market low to the bull market high to the bear market low is going to put our 1.272 Fibonacci right there at the $7,000 level. In addition to this, guys, we cannot ignore the fact that ETH is trading in a giant symmetrical triangle going all the way back to 2021. Something like this. Something like this. And we are currently breaking out and backtesting that big old symmetrical triangle. Right? We are currently breaking out and backtesting that current symmetrical triangle, forming a bull flag here. If we are to take the measured move of the triangle from the bear market low to the top of the triangle and extend this, well, that's going to actually take us to our 1.618 Fibonacci, right around an $8,500 ETH. So either way, we have some very bullish targets based on Fibonacci trend-based extensions here. And so long as ETH is going to hold the POC at $3,300, I'd say more upside is probable. Of course, if we lose the point of control of the range, we must expect to move down to around $2,800 ETH. But so far, this is far from happening. We go to the 3-day time frame. We have just confirmed a nice bullish trigger wave, a continuation pattern after the bullish divergence we got back in April. This is what we're looking at with Bitcoin and ETH, guys, as we are 12 minutes away from Jerome Powell coming out the dang closet, flapping his gums. Now we want to take a look at USDT dominance. USDT dominance, guys. Because USDT dominance, as we mentioned, at the beginning of the stream, people are rotating their crypto into stablecoins. We're seeing stablecoin inflows rise as people are awaiting the federal funds decision. Really, here's the thing. The fact that we're seeing this doesn't mean people are waiting for the rate decision. It means people are waiting for the press conference to see how Jerome Powell is, let's go to Forex Factory. To see what his outlook is going to be for the future. Okay. So, let's see here. FOMC right here. All right, everyone's expecting that 25 basis point cut. So USDT dominance. We're going to start on the weekly time frame. Remember, this is inverse to Bitcoin. So USDT looks bullish. Bitcoin, we expect a bearish move here. So we've been noticing this now literally for over a year, that as the price is getting or forming this double bottom, we are seeing momentum come up here on the USDT dominance. However, I think it's important, and I think we shouldn't ignore the fact that so far this is simply just consolidation. This is a descending triangle, which honestly is a bearish pattern. If we're going to be textbook about it, this is a bearish pattern, right? We are seeing momentum come down. We are seeing consolidation both on market cipher B and on the price action itself. And this is the weekly time frame. So I would say this, definitely some bullish vibes here, right? Bullish vibes, but overall neutral. Okay, overall neutral. I'd say we really would need to see, before we get overly excited about a major dump in the markets, we would want to see this trend line breached here. All right, this trend line has been respected since 2024. We see a breach of the trend line, something like this. Then I'd say we could say, man, this is looking pretty bad. Bad for crypto at least. Let's go to the daily time frame. I would say this, on our daily, you know, we've got a nice bottom here, and we do have a change of structure. So we have some local bullish market structure here, which means that does open up the door for at least another about 18% move here for USDT dominance up to 5.74%. So this is something to keep in mind if the Fed comes out hawkish and we start to see the USDT dominance rise up to this trend line. This could be the place where, if we're finding resistance here on USDT, be looking at the Bitcoin chart to see if we have major support to potentially take it all the way back down to the bottom here for a nice rise on Bitcoin and ETH. And this could be our final push of the bull market leading up into Q1 of 2026, right? This is basically, we're looking at November and then a big old rally up into Q1 of 2026, hypothetical, all right? Let's quickly take a look at total 3, all right? Well, before we take a look at total 3, let's take a look at Bitcoin dominance. All right, Bitcoin dominance. Oof, wow. Would you look at this? On October 10th, man, people were FOMOing into Bitcoin. This is a good sign to me, you know, as a guy who's really big into Bitcoin, it's a really good sign to me when you see people FOMOing into Bitcoin from altcoins, right? It just goes to show you that there's only one Bitcoin, guys. And people know, Bitcoin is a safe place to put your crypto. Bitcoin ain't going nowhere, man. The market starts to dump, people are like, let me put it back into Bitcoin, man. Okay, so ignoring that, Bitcoin dominance is in this disgusting looking ascending channel here, all right? I have to be honest, this does not look very bullish for Bitcoin dominance. Now, this is also, if we go to the weekly time frame, a breakdown of another giant, ugly channel, okay? And technically speaking, that October 10th dump backtested this large ascending channel. Okay, what does this show me? What does this tell me? This tells me, guys, that altcoin season is right around the corner. A real altcoin pump where we see real money flow into altcoins, and we could see Bitcoin dominance come back potentially to our Fibonacci 618 retracement, which is going to be around 49%, just under 50%, to backtest the support resistance flip that we had here back in the last bear market, right? Would be very interesting. That could give us our rally on the altcoins that we've been waiting for. So overall, I'd say Bitcoin dominance is showing some signs of weakness on the higher term timeframes. We see a breakdown of a weekly channel. We see an ugly looking rising wedge on the daily. All right, don't be surprised if we continue down a little bit, which would give us big pumps on altcoins. And speaking of that, let's check out our total 3. All right, this total market cap excluding Bitcoin and ETH. Okay, as we look at this on the weekly time frame, what are we seeing here? Basically the opposite of the Bitcoin dominance. October 10th, we see a big wick to the downside, but a quick buyback. And we came to backtest a major support resistance flip. All right, so we saw this on all the altcoin charts. We saw this on XRP, we saw it on ETH, we saw it on AVAX. Huge, massive, hundreds of percent pumps after that dump. All right, people are putting money back into altcoins after that big dump. And we see the weekly time frame here. We are getting momentum to the upside. Money flow to the upside. It looks like upside is in the future, the daily time frame. We don't have any bullish divergences here. You could make the case that maybe we have a hidden bull div. I'd say the daily time frame is a little bit ambiguous here. But the fact that we are backtesting and holding this very key level is bullish, especially when we look at the bearishness of Bitcoin dominance, the neutralness of USDT dominance. Because remember, USDT dominance is inversely correlated to the crypto market. Bitcoin dominance and total three is inversely correlated to Bitcoin, right? So if Bitcoin dominance is going down and the rest of the market cap of crypto is going up, that means money is flowing out of Bitcoin into altcoins. But as long as USDT dominance is neutral, that's not a bearish sign for the crypto market. And when we look at assets like AVAX, okay, let me remove all this stuff. When we look at assets like AVAX, for example, and we are seeing weekly bullish divergences where AVAX literally has come down to the lows, right? Like literally has come down to the low. This is not just any low, it's the bear market low, with momentum getting higher, money flow getting higher. When we look at assets like XRP that have absolutely ripped below previous lows, backtesting extremely important support resistance flips with bullish weekly, monthly momentum, and we're seeing money flow out of Bitcoin into altcoins. In my opinion, this is setting us up for big pumps. All right, big old pumps. We're seeing the same thing with assets like Solana. All right, Solana, we are maintaining this trend line here. We're maintaining a trend line. We came down, took all the liquidity from these lows here back in the spring. And so I'd say that this sideways range right here on Sol, we have our clearly defined high up here, our clearly defined low right here. This to me is looking pretty nice. It's looking pretty nice. The fact that we took the lows, right? The fact that from that low to the high, we backtest the Fibonacci golden pocket. The fact that we're seeing money flow from Bitcoin into altcoins, not looking so bad. All right, so let's see what the rest of Q4 and the beginning of Q1 for 2026 is going to hold. And of course, this really, I think a lot of this is going to depend on JP coming out the dang closet, flopping his gums about where he thinks interest rates are going to be going in the future. Because whether we like it or not, guys, the traditional finance system does affect Bitcoin. All right, it does affect Bitcoin. Currently, right now, guys, Bitcoin is getting a bounce from the POC of the range here. All right, and this golden pocket. We are currently getting a bounce from the POC and this golden pocket here. We have 2 minutes until the interest rate decision. All right, we have 2 minutes until the interest rate decision. Let's get our Bitcoin chart on here. Let's go to our 1 hour time frame. I think that's a good 1 hour time frame. 1 hour is bottomed out here. So we are in fact bouncing from the POC of our local range right here, confluence with, I think, the Fibonacci golden pocket from the low to the high. Nope, we front ran that just a little bit here, guys. So let's keep our eyes. We have 1 minute until the decision, and then volatility incoming, baby. Volatility incoming, baby. Let's see, 41 seconds, guys. I got butterflies. Guys, remember, we're giving away $3,000 this stream, so make sure to sign up to KCEX using the link in the pinned comment in YouTube channel. We're gonna have 6 winners, each winning $500. All you need is a user ID. All right, so if you sign up using my link, you don't have to deposit anything. 6 winners, $500 each. Absolutely worth it. Also, KCEX is my favorite exchange to trade on because the fees are so low. All right, here we go, baby. 7 seconds. 7 seconds. Here we go. Pending. Let's check out what's happening here. This is the 1 hour time frame on Bitcoin. Just fresh 1 hour candle here. A little bit to the downside. Come on, baby. Okay, exactly as predicted. All right, nothing crazy here. Exactly as predicted. So that is step one. We have just back tested that POC. All right, back tested that POC. Let's see what happens now. All right, back tested that POC as support. Let's go to our 1 minute time frame here. Wow, look at that wick on the 1 minute, guys. Look at that wick on the 1 minute. All right. So we got the news exactly as predicted. Exactly as predicted, baby. Okay. All right. So in about half an hour, Jerome Powell is going to be coming out discussing with us his outlook on these markets. All right. Let's take a quick look at the order flow chart on Market Monkey to see what is happening short term here. Ooh, so we've just had quite a few longs open up. Longs opened up on this candle here. Look at that here. We've had about 14 million longs open up on that green candle. This is the 1 minute chart. And then we've had about another 2.6 million longs open. People are longing and shorting this. It really is actually a battle. Big increase of open interest. Open interest has come up from about 60.5 million all the way to 65 million. 5 million volume increase here in 1 minute. $5 million volume increase here in 1 minute. A lot of longs popping in. All right, a lot of longs popping in right here. Let's check out our market cipher B on the low time frame here, the 5 second. Look at this, forming a 5 second triangle. A 5 second triangle. It actually looks kind of like we might break this triangle, you know? Let's see what's going to happen here. Are we going to break the triangle? Is the Bitcoin price going to break the triangle? Look at that. Backtest the POC. Trying to break out a local triangle. Trying to break out a local triangle. Bitcoin backtest the POC. 1 minute looking nice. 6 minute looking neutral. 1 minute looking nice. 6 minute looking neutral. All right, let's see what happens here. Gonna get a nice, wow, look at the 1 minute candle. This is pretty intense here. Look at the 1 minute chart for Bitcoin. Looks like we want to get a push to the upside. Looks like we want to get a push to the upside right here on Bitcoin. Check out the order book here. We're seeing more longs opening up, guys. Wow. Look at this, even more longs opening up right there. 14 million longs. Another 4 million. All right, another 1 million longs opening up right here in this candle. We are seeing the longs opening up here. Let's go to our 15-minute time frame. You know, we are building some bearish-ish CBD here thus far. Let's check it out from back here. Yeah, but on the other side of that Bitcoin, we are also building some bullish CBD as we tap into this POC here. So this is going to be a very key level of support. This white line you see on the chart here, guys, this is the high volume node of pretty much all of the price action that we have been trading since October 10th. Going all the way back to October 10th, and even going all the way back here to July 2025. All right? So it's a battle right now between the bears and the bulls. 6 minute red dot looks like she might want to print here. Again, exactly as predicted. It was baked into the cake. 97% of a 25 basis point cut. That's exactly what we got. And now Bitcoin has gotten a back test of the support resistance flip here. And it looks like she wants to get a little bit of a push to the upside. All right. It looks like she wants to get a little bit of a push to the upside here. So let's see what's going to happen. Let's see who we got in the chat. Major shout out to everybody in the chat, guys. God bless you all. Shout out to Memory Man. Shout out to Make Me a Millie. Shout out to Nil O Dragon 95. Shout out to M Fonzos. Negative funding rate on Bybit. Shout out to Selena Anderson. They're going to drag this on for weeks before they finally pump it. Shout out to Wolf Crab, who shouts out Jason Casper. Are we going to pump or are we going to dump? Says Hokey Jeckifer. Sorry, it's impossible for me to read these new YouTube names here, guys. Alright, it's impossible for me to read these new YouTube names here. Okay, so we are getting a big old drop-a-roni to the downside here. Okay. Let's see what's going to happen. Big old drop-a-roni right now as we await Jerome Powell, and we bounced from the 886 fib. Come back down to support. Bounce from the 886 fib here. Let's go back to our 1 minute time frame. Man, oh man. This is volatility for sure. For sure. We come down to the Fibonacci Golden Pocket down here during the press conference. That could be a nice area of support. Alright. That could be a nice area of support. Let's see who else we got in chat. Shout out to HFG in the chat. Why are the names like this? I don't know, J-Boy Bullish. YouTube did something different. Are we going to get another big dump like last time? Well, only time will tell, okay? Typically, guys, I don't like to take trades on news unless I'm already in a position, alright? And honestly, I already have taken 3 losses today, guys. So, I'm already down over $2,500 on the day. So, I've gotten, it has been a really bad day of trading for me. My worst day of trading in quite some time. And so to celebrate my $3,000 loss, I'm giving away $3,000 courtesy of KCEX. Alright, shout out to KCEX. Shout out to KCEX. KCEX. Lowest fees, guys. If you want to win $3,000 courtesy of KCEX, all you got to do is click the link in the pinned comment in the YouTube and sign up using my link, and then we'll do a random raffle, and if you win, 6 winners will get $500. Also, it's about 50-50 here whether or not JP will be hawkish or dovish. Alright? So it's about 50-50 right now. These 2 trades, guys, that I'm in here, the short trade and the long trade. The short trade was given in advance in the Casper crew. I let the crew know when I took it. The long trade was also given in advance. I let the crew know when I took it. I try to let the crew know when I take all my trades, my winners and my losers. If you want to join the crew, you can go to jasoncaspertrading.com. I've been trading altcoins in here as well. And we have 3 instructors every single day showing you their trades, their levels, their setups, and we do live trading 3 times a day. Alright? So let's see if we don't get a bounce here, guys. If we do get another move down during the press conference, I might have to go for another long trade. Alright? But let's see what happens. This backtest could be nice here, given the bullishness of our lower time frames and the bottomedness of our 12-minute. Let's check out our 12-minute here. Man, the 12-minute, if we get another move down, the 12-minute could look nice here. We'll have to wait and see. We've got about 22 minutes until the press conference. JP will be full of bollocks as usual. Yes, JP will be full of bollocks as usual. However, for some reason, he can move the market. All right, that's just how it is. For some reason, he can move the market. For some reason, he can move the market. All right, so just a little context here, another little bit of context here on the Bitcoin price is this. Let us not forget here, why is it so important? Why is this press conference so important? It's because when we look at what has happened here, in the context of it being Q4 of the bull run of the 4th year, we indeed, when we just look at this objectively, guys, we have formed some pretty bullish divergences on the daily time frame here. We have formed some pretty bullish divergences on our 2-day time frame, our 3-day time frame, bullish divergence. All right, as the price is getting lower, we're seeing the uneven butt cheek pattern, big and juicy on the left, nice and skinny on the right. Okay, and so this does allow us to expect more upside, especially since we are currently holding the POC in the value area low of the range. Also, let's zoom out even more and understand that we are seeing a massive bullish backtest of the range going all the way back to December 2024. All right, So look at this, guys. Bullish divergences as we are back testing major support. If we start to see bullishness inject into the market via Jerome Powell, it could give us the continued relief that we need to hit our next Bitcoin target of around $130,000. All right, in addition to this, we are noticing the fact that as we expect one more big push for Bitcoin, we are noticing that Bitcoin dominance is looking kind of bearish. All right. We are noticing that Bitcoin dominance is breaking down from a channel on the weekly time frame. October 10th gave us a bearish backtest of that channel. And now we're forming a bearish channel on the daily. In other words, it looks like we're finally seeing money rotating out of Bitcoin into altcoins. This to me looks like a bear flag, which means we could see Bitcoin dominance take another tumble down to around 54%, which is going to be taking out this last low that we made on December 1st, 2024. This could give us that big push for that big altcoin season that we have all been waiting for. All right. This is also in the context of, if we take a look at the total three, we're seeing bullishness. We're seeing a major back test of a key support resistance flip that goes all the way back to the spring of 2024. And we literally saw 700 billion up to over 1 trillion, right? $300 million. $300 million over the course of 2 days. I mean, honestly, this 3-day candle here, yeah, $300 million coming into altcoins over the course of 2 or 3 days. All right. So all these things together, I feel if we have a bullish Jerome Powell, could really spark off another little run to the upside. Again, we're looking at these charts like, for example, AVAX, which literally took the low with extremely bullish divergences on the weekly time frame. When Bitcoin dominance is bearish, total 3 is bullish, and we're seeing charts like this where the lows have been taken with ultra bullish divergences. I mean, look at this, guys. Look at this. Crazy. I mean, we took the low from the bear market. All right, we look at assets like Chainlink. Oh my goodness, man. Would you look at Chainlink? We took the low from July 2024. Not only did we take the low, but we backtested the bear market support resistance flip. You know, look at this. And we did so with extremely bullish divergences. Look at this. As the price is getting lower, money flow on the weekly, everything is pointing to a big altcoin run, guys. The thing that we've been waiting for. Everything is pointing to that right now. And I think the time is right. As we await Jerome Powell, as we await him coming out the dang closet, Chainlink on the daily. I mean, even on the daily, we've got bullish divergences here. You know, it's looking pretty intense. Bitcoin is collapsing right now, says somebody. Let's check it out. Bitcoin is collapsing. Let's see. Are we collapsing? I don't know. I don't know. I mean, this hedge short, I've taken a profit on it, guys. But this hedge short I opened up on Monday, it's the one I told my community about. Because we hit a TP1 on our long trade. We hit the TP target from the long trade that we gave in the Casper crew. We came up to that target right around this box. And so I said in the Casper crew that this is a great time to open up a hedge. So that is what I am currently doing here with that. And then, of course, we're in the short trade from the setup given in the Casper crew and taken in real time. All right, guys, we have about 15 minutes until the press conference. We're going to be watching live here. We're going to be watching the volatility on Bitcoin and other assets here, the stock market, all the markets, as the Bitcoin price is currently chilling around POC, local and macro. We're going to be watching our key levels here. All right, we're going to be watching our key levels here. Let's pull some fibs. There we go. Let's see who we got in the chat right now. Shout out to Splashfire Films. He says the best place to be, JasonCasperTrading.com. Shout out to Evan Edrock. Shout out to AAA Becca. My TA says Bitcoin's looking bearish, but I usually do long and my bearish TAs works every time. Okay. Hedge D's Newts. Hedge D's Newts. All right. We're going under 100,000. Let's talk about some bearish scenarios here for Bitcoin. All right. Let's talk about some bearish scenarios here for Bitcoin. All right. There is a chance. All right. There is a chance for Bitcoin that if the high is in, all right, let's just war game a little bearish scenario here, okay? The high, let's say, is in, right? The high is in. We've made a lower low, not with the candle close, by the way, just with the wick, and then we make a lower high. That lower high is going to be coming in somewhere around right where we actually did already top out, somewhere around here. And so, yeah, if Bitcoin rejects from our key resistance above 116.8 to 118, then our next target, guys, is going to be this 98,000 low from June. All right, that would be our next target. Okay, now, if we look at all the volume that's traded since November 2024, that is also our high volume node. And if we take our Fibonacci golden pocket from the low to the high, that's also our Fibonacci 618. So yeah, if we reject from there, this is going to be a big target, around 94 to 98,000 USD, okay? This is a very key level, and this is a level where if we come down, we need to be looking for a bounce, all right? That level, let's go ahead and take a trend line here. I mean, would you look at that, guys? Would you look at how key of a level that is? that is such a key level, man. All right. I mean, we could fudge this trend line, but if we put it exactly on the wicks there, this is a major level for Bitcoin. If lost, could open the door to, in my opinion, the next major support resistance flip, which is going to be between 65 and 75,000. All right, basically to back test the previous bull market all-time high, which would be a 50% correction from our current all-time high. That's not something we need to worry about unless we lose this area right here, okay? Because really, when we think about this, we just look at this objectively, which is what we should always be trying to do when we're coming to the Bitcoin charts. We're going to look at this objectively. You could say, okay, where's the sideways range? Well, this is our clearly defined low, and this is our clearly defined high. All right? This is the range that we're currently trading on the high time frame. So because this is our low, and because our major support is right there at that low, you would expect that if we're not going to bounce from here and continue up, we would come back down toward this area, right? So we're just being objective, right? We're just being objective. Now, if we lose this area, right, then what's the next range that we have? The next range we have is going to be this. We have a clearly defined support resistance flip, and we have our clearly defined high, okay? In addition to that, if we take all the volume here, let's see. I'm wrong. I could have sworn that we had, that's a little bit lower than what I thought it was. Maybe I was looking at this. It's a little bit lower than what I thought it was here, guys. I thought for a second that we had a value area high right in that area. Let's do something different. Let's try this. okay, we have a high volume node right there. And we have the support resistance flip from around $65,000. Yeah, I'd say between 65 and 75, that's going to be the range low. Right? That's going to be right around our range low. We have our range low here. We have our range high right up here. This is going to be the range to trade. You know, do something like this. And then enter back into the bull market. If we flip the scale upside down, guys, right? Let's just flip the scale. I did post this on Twitter, right? I asked, what happens next? You know, what happens next here? We have a very key level up here, a support resistance flip. What happens next on this chart? When you have bullish divergence like this, money flow coming up, momentum coming up, price consistently making lower lows. Well, you would expect that we backtest this level, right? I mean, we have the support resistance flip right here. If this was the 10-minute chart, if this was the 10-minute chart and we were all day trading, we would all come here and we'd all be looking for taking out $75,000. We would all be saying the best short to take would be to take the high, reject from the support resistance flip, and then make another low in this downtrend, right? We have bullish divergence. We'd say, you know what? Overall, we're in a bearish trend, but let's see if we can't trade the sideways range for a little bit to form the bear flag before we continue down lower, right? Well, this is Bitcoin upside down. We flip it right side up. Now we can see, oh yeah, looks like things are getting a little bit overextended here. We need to come back and consolidate, form a bull flag before the big break, right? So I'm just saying, you know, we've got 8 minutes until JP comes out flapping the gums, and this I think is going to be a big decision maker for the future of the Bitcoin price. All right, let's zoom in here, see what's going on. We are doing a whole bunch of nothing as we await Jerome Powell to come out and tell us what's going to happen next. All right, no freestyle today, homie. See me gab at 23K waiting. That's funny. Oh, you want a freestyle today? Maybe. Shout out to Make Me a Mill. Are we long? The only long I'm currently in is the long from October 22nd. That's the only long I'm currently still in right now. All right, we have 7 minutes, guys. Let me see if I can't get him ready. See if I can't get Jerome Powell ready here. I'm going to get him ready on the screen. We got him ready to go whenever that may be. And we're going to listen to him live, guys. Listen to him live. 7 minutes. Guys, remember, if you want a chance to win $3,000, sign up using my link for KCEX. All right. And you will be eligible to win. All right, give me 1 second here. All right, we're back, baby. 5 minutes. In fact, while we wait for JP, why don't we do the giveaway now? Right? Why don't we do the giveaway right now? Guys, what I need you to do is I need you to go into the YouTube chat and spam your KCEX user ID. Your KCEX user ID that you acquired by clicking my link, which is in the pinned chat here. Go ahead and spam the live chat with your user ID. And we are going to pick some random numbers here. All right, spam it, spam it, spam it. Spam it, spam it, spam it, spam it. Spam it, spam it, spam it. All right. We're going to count down from 10. And then we are going to pick 5 winners, all right? You ready? 10, 9, 8, 7, 6, 5, 4, 3, 2, 1. All right. So we have ourselves some winners here. Oh, crap. Let me see. The winners are, starting with Flip a Frank. All right, Flip a Frank, and then Recycle. So 1, 2, 3, 4, 5. All right, our winners are Flip a Frank, Recycle. Let's read them off here. Oh, I already copied them. Awesome. Our winners are Flip a Frank, Recycle, Ayarushasini 33, Prima Vids, and The Real Benja. Congratulations, The Real Benja, Prima Vids 3, Ayush 33, Redot Psycho, and Flip a Frank. You guys have just won $500 each. And it is 3 minutes until good old fashioned Jerome Powell. All right, while we're waiting for Jerome Powell, I'm going to send these user IDs over to KCEX. All right, shout out to Recycle with the uneven butt cheek emoji there. All right. Awesome. You guys have just won $500 each. I'm going to send that over to KCEX right now. Awesome. Congratulations, guys. Congratulations. 2 minutes until Jerome Powell speaks here. Let's see. We have our waiting music. Looks like there's something up with this here. Looks like we might have to refresh it. Here we go. Here he is.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Although some important federal government data have been delayed due to the shutdown, the public and private sector data that have remained available suggests that the outlook for employment and inflation has not changed much since our meeting in September. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals and in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by a 1/4 percentage point. We also decided to conclude the reduction of our aggregate securities holdings as of December 1. I will have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a moderate pace. GDP rose at a 1.6% pace in the first half of the year, down from 2.4% last year. Data available prior to the shutdown show that growth in economic activity may be on a somewhat firmer trajectory than expected, primarily reflecting stronger consumer spending. Business investment in equipment and intangibles has continued to expand, while activity in the housing sector remains weak. The shutdown of the federal government will weigh on economic activity while it persists, but these effects should reverse after the shutdown ends. In the labor market, the unemployment rate remained relatively low through August. Job gains have slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Although official employment data for September are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index suggest that total PCE prices rose 2.8% over the 12 months ending in September, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8% as well. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or two or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a 1/4 percentage point to 3.75% to 4%. Higher tariffs are pushing up prices in some categories of goods, resulting in higher overall inflation. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. With downside risks to employment having increased in recent months, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. We continue to face two-sided risks. In the committee's discussions at this meeting, there were strongly differing views about how to proceed in December. A further reduction in the policy rate at the December meeting is not a foregone conclusion. Far from it. Policy is not on a preset course. At today's meeting, the committee also decided to conclude the reduction of our aggregate securities holdings as of December 1. Our long-stated plan has been to stop balance sheet runoff when reserves are somewhat above the level we judge consistent with ample reserve conditions. Signs have clearly emerged that we have reached that standard. In money markets, repo rates have moved up relative to our administered rates, and we have seen more notable pressures on selected dates, along with more use of our standing repo facility. In addition, the effective federal funds rate has begun to move up relative to the rate of interest on reserve balances. These developments are what we expected to see as the size of our balance sheet declined and warrant today's decision to cease runoff. Over the 3.5 years that we've been shrinking our balance sheet, our securities holdings have declined by $2.2 trillion. As a share of nominal GDP, our balance sheet has fallen from 35% to about 21%. In December, we'll enter the next phase of our normalization plans by holding the size of our balance sheet steady for a time, while reserve balances continue to move gradually lower as other non-reserve liabilities, such as currency, keep growing. We will continue to allow agency securities to run off our balance sheet and will reinvest the proceeds from those securities in Treasury bills, furthering progress toward a portfolio consisting primarily of Treasury securities. This reinvestment strategy will also help move the weighted average maturity of our portfolio closer to that of the outstanding stock of Treasury securities, thus furthering the normalization of the composition of our balance sheet. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting our maximum employment, bringing our inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, are you uncomfortable with how market pricing has assumed a rate cut is a foregone conclusion at your next meeting?
Well, as I just mentioned, a further reduction in the policy rate at the December meeting is not a foregone conclusion, as I've just said. So I would say that needs to be taken on board. We had, just say this, 19 participants on the committee. Everyone works very hard at this and takes their obligations to serve the American people very seriously. And at a time when we have tension between our two goals, we have, strong views across the committee. And as I mentioned, there were strongly differing views today. And the takeaway from that is that we haven't made a decision about December. And, we're going to be looking at the data that we have, how that affects the outlook and the balance of risks. And I'll just say that.
You and some of your colleagues have framed last month and maybe today, I won't put words in your mouth, there's a risk management exercise. At what point do you conclude that you've taken out enough insurance? Are you looking for some kind of improvement in the outlook, or could this unfold along the lines of last year, where you made a sequence of adjustments and then waited to gather more information?
So the way I've been thinking about it is the risks to the two goals for a very long time, the risk was clearly of higher inflation. And then that has changed now. And as we saw particularly after the July meeting, we saw the downward revisions in job creation, we saw a very different picture of the labor market and suggested that there were higher downside risks to the labor market than we had thought. And that suggested that policy, which we had been holding at a I would say modestly, others people would say moderately restrictive level, needed to move more in the direction over time of neutral. If the two goals are sort of equally at risk, then you ought to be at neutral, because one of them's calling for you to hike and one of them's calling for you to cut. So if that got back into balance, then you'd want to be roughly at neutral. So in that sense, it was a risk management. And I would say the same about today, sort of the same logic. But as I mentioned, going forward is a different thing.
Claire.
I'm Claire Jones, Financial Times. Thank you for taking this question. We've just heard from you that the discussion in December and the conclusion of the discussion is not a foregone conclusion. I'd like to just dig into that a little bit more about what sort of arguments were brought up. Was there any consideration, for instance, of the investment we're seeing in AI and some of the generation of household wealth through rises in stock prices related to the AI boom? Thank you.
I wouldn't say that's a factor in everyone's assessment of the economy. I wouldn't say it's the driving factor. I don't think for anybody. I guess I would say it this way. Once again, I would just point out that we have the situation where the risks are to the upside for inflation and to the downside for employment. We have one tool. It can't do both of those. You can't address both of those at once. You've got a very different situation. So you have some people have different forecasts, right? So they'll forecast faster or slower progress on one or the other, and they also have different levels of risk aversion. And some will be more averse to inflation overruns, and some will be more averse to underruns of employment. And so you put that together, and as you can see from the SEP and from the public discussion that goes on between the meetings when more participants go out and talk, they're very disparate views, and they were reflected in strongly differing views in today's meeting, as I pointed out in my remarks. And that's what leads me to say that, that we haven't made a decision about December. I always say that. It's a fact that we don't make decisions in advance. But I'm saying something in addition here, is that it's not to be seen as a foregone conclusion. In fact, far from it.
Can I just ask a quick follow-up on QT? How much of the fund impressions we've seen in money markets are related to the U.S. Treasury issuing more short-term debt?
That could be one of the factors, but the reality is we've seen, the things that we've seen, higher repo rates and federal funds rate moving up. These are the very things that we look for. We actually have a framework for looking at, what the place we're trying to reach. What we said for a long time now is that when we feel like we're a bit above what we consider a level that's ample, that we would freeze the size of the balance sheet. Of course, reserves will continue to decline from that point forward as non-reserve liabilities grow. So this happened, some things have been happening for some time now, showing a gradual tightening in money market conditions. Really in the last, call it 3 weeks or so, you've seen more significant tightening, and I think a clear assessment that we're at that place. The other thing is, the balance sheet is shrinking at a very, very slow pace now. We've reduced it by half twice, and so there's not a lot of benefit to be holding on to get the last few dollars, because again, with the balance sheets, the reserves are going to continue to shrink as non-reserves grow. So, there was support on the committee as we thought about it to go ahead with this and announce, effective December 1, that we will be, freezing the size of the balance sheet. And the December 1 date gives the markets a little bit of time to adapt.
Colby.
Thank you. Colby Smith with the New York Times. So much of the rationale for cutting interest rates, even as inflation moves away from the 2% target, seems to be, that there are these mounting downside risks to the labor market. But if those don't materialize and the labor market either stabilizes around current employment levels or even starts to strengthen somewhat, how would that change your perception of how much interest rates need to fall from here? Would you then be a bit more concerned about underlying inflation and the possibility of second round effects from tariffs?
Yeah, I mean, in principle, if you were to see data that suggested that the labor market's strengthening or even that it's stabilizing, that would certainly play into our decisions going forward. So, we do have, we get some data. The labor market is a place where we get, for example, we get the state level data on initial claims, which are sending a sort of a signal of more of the same. We also get job openings, and we'll get lots of survey data. We'll get the Beige Book and things like that. So we'll have a picture of what's going on in the labor market, and the fact that we're not seeing an uptick in claims or a downtick really in openings suggests that you're seeing maybe continued very gradual cooling, but nothing more than that. So that does give you some comfort.
But if this shutdown lasts a while longer and you don't have that data in hand, I'm just wondering how that hinders the committee's ability to assess the state of the labor market and make the right policy decisions, and also how much is that factoring into the debate about December?
Yeah. So we get like I mentioned what we get in the labor area. We get some data in inflation, some data in economic activity. And we'll have a picture of what's going on. We also will have the Beige Book again. I would say we're not going to be able to have the detailed feel of things. But I think if there were a significant or material change in the economy one way or another, I think we'd pick that up through this. So in terms of how it might affect December, it's really hard to say. December's the meeting's like 6 weeks away. We just don't know what we're going to get. If there is a very high level of uncertainty, then that could be an argument in favor of caution about moving, but we'll have to see how it unfolds.
Steve.
Steve Leisman, CNBC. Mr. Chairman, can you characterize the meeting in terms of, you said strongly differing views. Was this a close call, this cut, or was it a close call maybe the other way because you had dissents on both sides? Thanks.
So I was referring to the discussion about, to the extent it related to December. You saw we had two dissents, one for 50 and one for no cut. So, that was a strong, solid vote in favor of this cut. The strongly differing views were really about the future. What does that look like? And I think people are saying, they're noticing stronger economic activity. Forecasters generally, broadly, have raised their economic growth forecasts for this year and next year, in some cases quite materially. In the meantime, we see, a labor market that's kind of, I don't want to say stable, but it's not clearly in motion. It's not clearly declining quickly in any case. It may be just continuing to gradually cool. And again, people have different forecasts and expectations about the economy and different risk tolerances, and so there's you read the SEP, you read the speeches, there are differing views on the committee, and to the point where I said what I said.
And just to follow up on the balance sheet, if you stop the runoff now, does that mean you have to go back to actually adding assets sometime next year so that the balance sheet doesn't shrink as a percent of GDP and become a tightening factor?
So you're right. The place we'll be on December 1 is that the size of the balance sheet is frozen. And as mortgage-backed securities mature, we'll reinvest those in Treasury bills, which will foster both a more Treasury balance sheet and also a shorter duration. So that's what, in the meantime, if you freeze the size of the balance sheet, the non-reserve liabilities, currency, for example, they're going to continue to grow organically. And because the size of the balance sheet is frozen, you have further shrinkage in reserves. And reserves is the thing that we're managing that has to be ample. So that'll happen for a time, but not a tremendously long time. We don't know exactly how long. But at a certain point, you'll want to start reserves to start gradually growing to keep up with the size of the banking system and the size of the economy. So we'll be adding reserves at a certain point, and that's the last point. Even then, we didn't make decisions about this today, but we did talk today about the composition of the balance sheet, and there's a desire that the balance sheet be right now it's got a lot more duration than the outstanding universe of Treasury securities, And we want to move to a place where we're closer to that duration. That'll take some time. We haven't made a decision about the ultimate endpoint, but we all agree that we want to move more in the direction of a balance sheet that more closely reflects the outstanding treasuries, and that means a shorter duration balance sheet. Now, this is something that's going to take a long time and move very, very gradually. I don't think you'll notice it in market conditions, but that's the direction of things.
Janelle.
Janelle Marte with Bloomberg. How are officials interpreting the latest CPI report? So some components came in lower than expected, but core inflation was still at 3%. So at this moment, what are you learning about the drivers? And also, do you view that the risks are greater that the Fed makes a mistake on employment or inflation?
So the September CPI report, we didn't get PPI after that, which is important for translation into what we look at, which is PCE inflation. But we can still make a pretty good assessment of what that will be. When we get PPI, there might be some adjustments. But so directionally, it was a little softer than expected, and we always break it down into the three components. So basically, you've seen goods prices increasing, and that's really due to tariffs. And that's compared to a longer run trend of very, very mild deflation in goods. So that's moving inflation up. On the other side of that, good news that housing services inflation has been coming down and is expected to continue to come down. So if you remember a couple of years ago, that's the one that we kept expecting it to do that. Now it's been doing that for some time, and we expect to continue that. That leaves the biggest category is services other than housing services. And that's kind of been moving sideways over the last few months, but a significant part of that is non-market services, and we don't take a lot of signal about the tightness of the economy from that. So if you add all that up, a couple things to say. One is that inflation away from tariffs is actually not so far from our 2% goal. We estimate, people have different estimates of what that is, but it might be, 5 or 6 tenths, and so that, if it's 2.8, then core PCE, not including tariffs, might be 2.3 or 2.4 in that range, something like that. So that's not so far from your goal. So that we look at that, and the thing about tariff inflation is the base case is that it will come, and it probably will increase further, but it is that it will be a one-time increase. And we've been very focused for all of this year at making sure that that's the case and thinking carefully about what are the pathways through which it could become something else, troublesome inflation. One of those would be, a really tight labor market. We don't see that. Another could be inflation expectations moving. We don't see that. So I think, we're watching this very carefully. I think it's not the case that we're just assuming that it's going to be a one-time inflation. We understand fully that this is a risk we have to monitor and ultimately manage.
With the stubborn in services inflation, what are some of the things that the Fed could do to address that, and especially when we're seeing potentially labor supply challenges?
Sorry, say the first.
The stubborn services inflation that you mentioned.
Services inflation, yeah. Well, again, the part of services inflation that isn't coming down as we would like it to is the non-market part of non-housing services. And overall, that's just something that we expect will come down. The non-market part of it should come down. It largely reflects higher stock prices and financial services that are imputed rather than actually paid is a big part of that. But also just, we think policy is still modestly restrictive in my telling. So that's the kind of thing that should lead to a gradually cooling economy. That's one of the reasons you see a gradually cooling labor market is because the Fed policy is modestly restrictive. So that should also help get that. I want to say, though, we're absolutely committed to returning inflation to 2%. If you look at longer-term surveys or market pricing, you will see that's a credible commitment, and there should be no question that that's where we're going.
Chris.
Great, thank you. Chris Rugaber at Associated Press. So there's a big investment boom in AI infrastructure right now, as you know, and wondering if the existence of such a boom would indicate that rates are not that restrictive after all. And could further rate cuts at this point perhaps fuel an excess level of investment there or market bubbles? How is the Fed thinking about that?
So I don't think that you're right. There are a lot of data centers being built and other investments being made around the country and around the world. Big U.S. companies are just investing a lot of resources in thinking about how AI, which will be based on those data centers, run through those data centers, is going to affect their businesses. So it's a big deal. I don't think that the spending that happens to build data centers all over the country is especially interest sensitive. It's based on longer run assessments that this is an area where there's going to be a lot of investment and that's going to drive higher productivity and that sorts of things. I don't know how those investments will work out, but I don't think they're particularly interest sensitive compared to some of the other sectors.
And then just a quick follow-up. You mentioned that you do have data that you're looking at for inflation and growth in the absence of government data. Could you give us a sense? I think we know a lot about the jobs data that's out there. Can you give us a sense of what you're looking at to track inflation in the absence of government data? Thank you.
So it's a lot of things, and it doesn't replace government data, but you know all of these. I'll just mention some of the many names: Price Stats, Adobe, and others. For wage inflation, there's ADP data. On spending, you're going to ask about spending at some point. There are lots of other things that we look at, but it's many different sources, and again, including what we get out of the Beige Book, which will be sort of come out mid-cycle as always. And it doesn't replace the government data, but it gives us a picture. Again, I think if something material were happening, if there were material developments, I think we would pick that up. I don't think we'll be able to have the very granular understanding of the economy while this data is not available.
Howard.
Howard Schneider with Reuters. Thank you. I just wanted you to elaborate a little bit on what you said a moment ago about a continued shutdown, making it more difficult to make a move in December, and that may make you more cautious. To the degree you are relying on private data that isn't the gold standard, or that you're relying on your own surveys of the Beige Book, do you worry at some point you're going to have to start making policy by anecdote?
This is a temporary state of affairs, and we're going to do our jobs. We're going to collect every scrap of data we can find, evaluate it, and think carefully about it. And that's our jobs. That's what we're going to do. If you ask me, could it affect the December meeting? I'm not saying it's going to, but yeah, you could imagine that what do you do if you're driving in the fog? You slow down. So that could or could not. I don't know how that's going to play into things. We may get the data may come back, but there's a possibility that it would make sense to be more cautious about moving. I'm not committing to that. I'm just saying it's certainly a possibility that you would say we really can't see, so let's slow down.
As a follow-up in the debate on this meeting, we saw recently some pretty big layoff announcements coming from Amazon and others. Wondering if that figured into the discussion at all, that you're starting to see this tension between growth and employment starting to be resolved, to the detriment of employment. And secondly, some of the stress is starting to appear in the bottom spur of the K, as they call it, household health premiums that are going to possibly be going up quite substantially, things like that. Has that started to become a factor in your policy discussion?
So those are both things that we're watching very, very carefully. To start with the layoffs, you're right. You see a significant number of companies either announcing that they are not going to be doing much hiring or actually doing layoffs, and much of the time they're talking about AI and what it can do. So we're watching that very carefully, and yes, it could absolutely have implications for job creation. We don't really see it in the initial claims data yet. Now, it's not a surprise that we don't. It takes some time for it to get in there, but we're watching that really carefully. But again, don't see it yet in the initial claims data. On the K-shaped economy thing, I would say the same thing or similar thing. We are, if you listen to the earnings calls or the reports of, big public consumer-facing companies, many of them are saying that there's a bifurcated economy there, and that consumers at the lower end are struggling and buying less and shifting to lower-cost products, but that at the top, people are spending at the higher income and wealth, and so much anecdotal data on that, and so we think there's something there.
Edward.
Thank you. Edward Lawrence with Fox Business. So, Mr. Chairman, I want to take another crack at the further reduction of rates is not a foregone conclusion. So in December, you said, far from it. So if a cut might not be on the table for December because of lack of data, what does the other concerns then stem from? So if it's not lack of data as the reason December is not a foregone conclusion, what other things could be the concern then? Well,
the perspectives of people on the committee that, we've now moved 150 basis points, and that we're down into, you're into that range between 3 and 4 where many estimates of the neutral rate live in that 3 to 4% area. You're there now. You're above the median number for the committee, but I think there are people on the committee who have higher estimates of the neutral rate, and that's you can argue these positions since it can't be directly observed, the neutral rate. So, I think for some part of the committee, it's time to maybe take a step back and see whether there really are downside risks to the labor market, or see whether in fact the growth that the stronger growth that we're seeing is real. Ordinarily, the labor market is a better indicator of the momentum of the economy than the spending data. That's the lore. In this case, that gives a more downbeat read. So people just have, again, we've cut 50 more basis points in the last 2 meetings, and there's a sense like, from some, let's pause here, kind of thing, and a sense from others wanting to go ahead. But that's why I say differing views, strongly differing views.
So on that division then you're talking about going forward, so what's more important in this division? Is it inflation risks, is it employment risk, or is there a deeper philosophy division among the board?
Look, everybody on the committee is deeply committed to doing the right thing to achieve our goals, maximum employment and stable prices. You have differences on how to do that, and as I mentioned, some of that is different forecasts, but a lot of it is also different risk aversions to the different variables, which is common through all Federal Reserves. People just have different risk tolerances, let's say. So that leads you to people with disparate views. You will know that from the speeches you've been listening to from my colleagues, and so we're at a place now where we have in fact cut 2 more times. And we're 150 basis points closer to neutral, wherever that may be, than we were a year ago. And so there's a growing chorus now of feeling like maybe this is where we should at least wait a cycle, something like that. That's what it is. It's just what you think it would be. It's and again, you've seen it in the September Summer of Economic Projections. You've seen this in the public remarks of FOMC participants, and now I'm telling you that's what you can expect that in the minutes. And I'm just telling you that's what happened in the meeting.
Elizabeth.
Thank you so much. Elizabeth Scholzley with ABC News. What is your explanation for why the job market is weakening right now, and what will this rate cut do to improve the job market?
So I think there are 2 things affecting the job market, and one of them is just a dramatic reduction in the supply of new workers. And that's 2 things. That's declining labor force participation, which is a cyclical thing. And then there's declining immigration, which is just a big policy change that actually began in the last administration and has been accelerated now. So a big part of the whole story is that supply side story. Okay. In addition, labor demand has declined, and so the unemployment rate has gone down, meaning that demand for workers has gone down a little more than supply. So that's what's going on, but it is mostly a supply function. It's mostly a function of the change in supply, I think, and many people think. So the question then is, what does the our tool do, which supports demand, and and I would just say, when you're in a situation where job creation, if you adjust for likely overcounting in the way that BLS does its work, is pretty close to zero. So maximum employment doesn't, on a sustainable basis, if you're creating zero jobs, if it's in equilibrium, if it's in balance, it's a pretty, as I said before, a pretty curious balance. So, I thought, and many of my colleagues thought, in fact, you've seen the last two meetings, that it was appropriate for us to react by supporting demand with our rates. And we've done that. We've reduced so that rates are looser. I wouldn't say that they're accommodative right now, but they're meaningfully less tight than they were. And that should help so that at least the labor market doesn't get worse. So it's a complicated situation, and some people argue that this is supply and we really can't affect it much with our tools, but others argue, as I do, that there is an effect from demand and that we should use our tools to support the labor market when we see this happening.
You also talked about tariffs causing a one-time price increase. Should American household consumers expect that inflation will continue to go up this year because of those tariffs?
So the basic expectation is that there will be some additional increase in inflation because it takes a while for tariffs to work their way through the production chain and finally get to consumers. And we see this now from the tariffs that were put in place now many months ago. We see those effects, but if you put tariffs in effect, and they've been coming into effect consistently in February, March, April, May, and that's all happening. So that'll continue to happen for some time, probably into the spring. These are not big increases, though. These are a tenth or so on inflation. They may be big increases on a particular product that's been tariffed, but overall, these are fairly modest. I think some projections go, we're at 2.8% inflation. You might get 2 or 3 more tenths or 4 more tenths maybe. But then, as all of the tariffs are in, they stop generating inflation. You've had a one-time price increase. As long as you're not, at least this is the theory, this is how we believe and hope that it will work out. Once the last tariff is put on something, at that point, it becomes a higher price level, but it stops going up, if you will. Prices stop going up. They'll just be at that level. And then measured inflation will come back down to non-tariff inflation. As I mentioned, non-tariff inflation is not so far from 2% now. Now, consumers are not interested in that story. Their prices are higher. More than that, the reason they're so unhappy about inflation is the inflation that we had in 2021, 2, and 3. Because you can say that prices aren't going up as much, but that doesn't mean people aren't feeling those higher prices from the inflation we had 2 or 3 years ago. They are, and that's, I think, a large part of why the public, if you sample people, inflation is still very much making people quite unhappy. Even, and it's nice that, that prices are not going up as fast as they were, but they're still much higher than they were. And it'll take some time for that effect to wear off. As real incomes rise, it will feel better over time, but that's going to take time.
Michael McKee from Bloomberg Television and Radio. Do you have any concerns that equity markets are or are close to being overvalued at this point?
We don't look at any one asset price and say, hey, that's wrong. It's not our job to do that. We look at the overall financial system, and we ask whether it's stable and whether it could withstand shocks, right? So, banks are well capitalized, while some households are clearly under stress. In the aggregate, households are in good shape financially, relatively manageable levels of debt. At the lower income spectrum, you are seeing rising defaults, particularly around subprime auto, but nonetheless, in the aggregate, pretty good. And you don't see too much leverage in the banking system or the financial system. It's a mixed picture, but it's not an overly troubling picture. And again, I'm not, it's not appropriate. We don't set asset prices. Markets do that.
Well, you must be well aware that by lowering interest rates, you're contributing to additional asset price increases. And I wonder how you balance the idea that lowering rates would help the labor market with the reality that it seems more likely to be stimulating increased investment in AI, which is the rationale for thousands of job cuts that have been announced in the last few weeks.
Yeah, I don't think interest rates are an important part of the AI of the data center story. I think people think they're great economics in building these data centers, and they're making a lot of money building them, and they think they have very high present value and all that sort of thing. It's not really about about 25 basis points here or there. We use our tools to support the labor market and to create price stability. That's what we do. That's our two jobs, right? So we're here by lowering rates at the margin, that will support demand, and that will support more hiring, and that's why we do it. Now, no 25 basis point or even 50 basis point hike is going to be a dispositive thing, but ultimately, lower rates will support more demand, and that'll support hiring over time. And of course, we also have to be careful about this, which is what we've been doing, because we know where inflation is, and we know that, I've told you the story. It's a complicated story, but this is the best assessment that we can make. Because there's uncertainty around inflation and the path ahead for inflation, that's why the pace we're going has been a careful one.
Victoria. Hi, Victoria Guida from Politico. On AI, I'm just wondering, it seems like a lot of the economic growth that we've been seeing is fed by investments in AI. So how worried are you about what a sudden contraction in tech investment would mean for the overall economy? Is there enough strength in other sectors? And specifically, are there any lessons that you take from the 1990s in how you might approach what's happening right now?
Yeah, this is different. In the sense that the companies that are so highly valued actually have earnings and stuff like that. So if you go back to the 90s and the dot-com, these were ideas rather than companies, and so there's a clear bubble there. Whereas I won't go into particular names, but they actually have earnings, and it looks like they have business models and profits and that kind of thing. So it's really a different thing. The investment we're getting in equipment and all those things that go into creating data centers and feeding the AI, it's clearly one of the big sources of growth in the economy. Consumer spending also, though, has been, is much bigger than that, and has been growing, and has defied a lot of, negative forecasts, continuing to do so this year. Consumers are still spending. Now, it may be mostly higher-end consumers, or maybe skewed that way. But the consumer is spending, and that's a big chunk of what's going on in the economy, substantially bigger than AI. You could point to growth. I mean, actually, maybe growth as opposed to level, but consumer spending is a much bigger part of the economy.
And why do you think that the labor market is slowing so much, even though consumer spending is strong?
Why has it slowed so much? Well, what's happened is that the supply of workers has dropped very, very sharply due to mainly immigration, but also lower labor force participation. So, and that means there's less need for new jobs, because there isn't this flow into the pool of labor that, where people need jobs, because there aren't those people now. So there's not a supply of workers showing up for jobs. In addition, demand has also gone down, and so has labor force participation has declined, which is more of a sign, in this case, of demand as well as trend. So I think you're seeing some softening. The economy's growing at a slower rate than it was, 2.4% last year. We think around 1.6% this year. It could have been a couple of tenths higher if not for the shutdown.